Well, broadly speaking, there are two camps of investors. There are the longer-term investors who typically have acknowledged the economic power that is evolving in Asia and the rising political power that Asia has. And these investors are slowly and progressively using opportunities to increase their exposure to Asia. If you need any proof of this, you just need to refer to the chart where you'll see that over the last decade or so, performance of the Asian markets has more than doubled that of developed markets returns. And even the rolling 3 and 5 year returns show even more compelling performance by the Asian markets. Yeah, well, short-term investors are largely responsible for the month-to-month volatility we see in the Asian markets, and they're very much focused on the issues of the day. Most central banks are now tackling rising inflation, and this is no more evident, through the producer price levels that are feeding through also to the consumer price levels. And I think if we look at China, certainly there's an inflation issue going on there, and that's very topical. And we're now getting to a point, fortunately, where it appears that the rate of inflation is starting to peak out, and the central bank is making headway there. With regards to India, inflation has come down from very high levels, but still, on a regional context, inflation is very high, and the central bank needs to tackle that much more aggressively. With regard to economic growth, the risk and fear is definitely there that the policy tightening that's been undertaken is going to, while dealing with inflation, will overkill growth on the downside. With regards to China, unquestionably growth is moderating there, but it has come from a very high level post the GFC recovery, so it's still at a solid level. With regard to India, on the other hand, growth is struggling, and while it is strong in some parts of the economy, the government's focus is very much, and the central bank's focus is very much on tackling this inflation problem, and they're prepared, while they're acknowledging the risk to growth, they're prepared to run that risk while they deal with the inflation problem. Interest rates have been raised across the region to tackle the inflation problem. In China, we've now had 4 rate hikes, now in very much a lagged response in many people's eyes. But of course, you must give credit to the Chinese government and central bank that they are using a broad range of tools, and many of these were in play before interest rates. With respect to India, they are using interest rate policy in a very aggressive manner. They've raised rates now a good 9 times. And even the last rate hike has been much more aggressive than previous hikes of about 50 basis points. So they're very serious about using this tool to tackle inflation. Elsewhere across the region, virtually all markets and all economies have now started to hike their interest rates. With regard to liquidity and the excess capital which has been flooding into these economies, one of the key policy tools has been reserve requirements, and we've seen the Chinese government use bank's reserve requirement ratio more aggressively than any other, where they've now raised the requirement on banks by about 6.5%. So effectively they're locking up more than 1/5 of bank deposits. There are other tools that the countries are using and employing to deal with this excess liquidity, country or sector specific measures, bond issuance. And we've also had an unprecedented accumulation of foreign exchange reserves by China. This is an essential tool for dealing with the flood of capital coming into the market, but it's also a measure that they're using to contain or manage their exchange rate. With regard to currency, and particularly the RMB, the gradual appreciation of that currency has been painfully slow, particularly with regard or from the perspective of the major trading partner, which is the US. And they take the view that the overvalued RMB is a major distortion to global trade balances. Now, the Chinese are facing a real dilemma here, because if they appreciate too fast, the first point is that they would unduly put pressure on their exporters, and they're an important part of economic growth, and the government is clearly at pains to minimise that pressure. The other aspect would be that to undertake a rapid appreciation of the RMB, or in fact even a step appreciation, would simply be a loss of face to the Chinese when they are an emerging economic power with respect to the US. On the other hand, to not appreciate is removing a tool that gives you the ability to fight inflation. So there is a real imperative both ways that the Chinese want to move. Now, my view is quite clearly that the government will continue to manage the gradual appreciation of around 5–5.5% per annum of appreciation of the RMB. With regard to China property, China property has been driven by a very high turnover model, whereby companies turn over the properties quickly, generates the cash flow, which in turn allows them to move on to the next development, and so the cycle continues. Now, it's been going on for several years and there is an excess of supply in the market, unquestionably. However, the range of estimates varies from around 16 million apartments up to as high as 64 million apartments. It is virtually impossible for us to quantify that. But what we do know is the government is determined to deal with what it perceives as excessive price movements, and consequently it's imposed a range of measures specifically targeting property. We do anticipate further pain ahead in the property market. However, a lot of this is already priced into stock valuations. For this type of environment where we have a tightening phase ongoing, we can only really invest or trade in overbought or oversold situations. But this is a normal cleansing of a sector, and we would expect that the higher quality companies are going to use this time or this environment to accumulate at reasonably good prices, good land banking. Now, they are the type of companies that once we feel the tightening phase is over, that we would like to add to the portfolio. Earnings in the market enjoyed a great year in 2010. They were up 39%. This year we see growth coming back to a much more moderate mid-teens level, still a healthy rate. But the big question here is, will growth be able to achieve the mid-teens growth in the face of the policy pressures which are existing? Now, we view this as a normal economic cycle where we have a recovery. You invariably have inflation come through. You have central banks being required to, or having to take action to tackle that inflation. And once they begin to rein it in, you do see the fears that accompany tighter policy beginning to allay. The bigger question for me is, and for us, is really, will the demand from the West be able to be sustained, or will it falter? Supporting a view that underlying growth is very strong. We're seeing demand for capital coming through in a number of areas. Corporate bond issuance is one. High retained earnings is another, where the payout ratios have actually dropped by about 10% down to 34%. And equity issuance is very strong. Normally, equity issuance is something that you see in strong or bull markets. But in this environment where, particularly this year, we've had a very weak environment, equity issuance has continued on at a very healthy rate, which suggests to us that the underlying growth is there for these companies and they're seeking capital which has not been available because of the liquidity tightening policies of governments at this point. Sales volumes have been one of the primary driver of the recovery over the last 18 months in earnings. However, they have been very strong at high levels and we would expect them to revert to mean. That said, mean is still quite reasonable, but it's not the strength we would have seen previously. Margins haven't fully recovered through this part of the cycle. There are cost pressures coming from labour, from material input goods, and of course with higher interest rates come higher capital costs. And none of these pressures we expect to abate in the near term. Equities across Asia are trading at very cheap multiples of around 12 times. If you refer to the chart, you can see that this is the cheapest we've had, excluding the GFC, over the last 5 or 6 years. The issues that we've been discussing have been particularly relevant in pushing valuations down to this level, but of course there are exogenous factors, and the US economic recovery is one, but also the Greek and EU sovereign debt issue is certainly weighing on investor sentiment at this point, causing the lower valuations. Is 12 times valuation expensive for markets? Well, in our view, it's an attractive point. We have to ask the question, are earnings at this level reasonable, and because we don't subscribe to the view that economic growth is going to be overly punished by current policies, we actually view this as an attractive entry point into the Asian equity market. For equities to perform over the next 3 to 6 months, first and foremost, we really need to see inflation topping out, and we would expect the data to be released over the fourth quarter would confirm this. Secondly, we need to see that the policies that have been implemented by governments and central banks haven't overly impacted on growth on the downside. And I guess lastly, we need to be assured that the growth recovery in the developed markets, particularly the US, does regain its footing. Should all of these aspects align, we would expect that equities in Asia will have a relatively strong second half to this year.